Welcome to weekly podcast Max Moves, where we'll be discussing, like always, Mexican business and investment. Hi, Damien. You've been doing a lot of research on Mexican companies investing abroad. What do you have for us?
Sure, Eduardo. Hello, how are you? As you know, Mexican companies over the last 35 years really have been investing, listed Mexican companies have been investing heavily outside Mexico, especially in the United States. And they've been doing this for different reasons. One, to diversify risk. Don't want to have all their eggs in the Mexican basket. Two, because typically, not in every case, but typically they generate a lot of free cash flow in Mexico. So they can use that free cash flow to grow elsewhere. And third, especially in the case of the US, they feel at least that they have a captive market with 25 to 30 million Latinos in the US, familiar with Mexican products, Mexican culture. And maybe fourth, a lot of the top executives of Mexican companies went to business school in the United States, lived in the United States, probably have family in the United States. So they feel very comfortable operating in the United States and feel they can compete effectively against their US peers. So that's been the theory. The reality has been a lot more mixed.
Well, that was my next question.
They haven't, on average, and there's lots of exceptions, they haven't been able to replicate their success in Mexico. The first big investment by a Mexican listed company in the US was Vitro, which bought Anchor Glass, and that failed, as we're about to hear from our special guest, Alvaro Rodriguez. That failed fairly spectacularly, and both Anchor Glass and then Vitro went into Chapter 11, and Vitro, with the benefit of hindsight, took on too much debt. The glass market became very competitive due to mergers in the sector that left Anchor Glass a smaller player. And then bet prices went up, which squeezed their margins. And all in all, Vitro went from being the largest private company in Mexico to basically, these days, a very, very small company from stock market terms and a company that has offered shareholders disastrous returns. So that didn't work. Another failure, and I will come to some successes, was Cemex, definitely the biggest failure in dollar terms.
Correct.
Back in 2008, they spent $15 billion on the Rinka Group, which was Australian, but had most of its assets in the US. And that led Cemex to become highly leveraged at just the wrong time, just before the 2008 financial crisis. And unfortunately for Cemex, they took a decision at the time to finance themselves with short-term debt. And on top of that, obviously, construction, which is linked to cement, is highly cyclical. So when we saw the financial crisis, which was also a housing crisis, come in, people stopped building and cement demand collapsed. So they were left with a lot of debt and much less cash flow. They managed to, they lost their investment grade rating, and needless to say, they managed to avoid bankruptcy, but I think at times it was a very close thing. Yeah. But the stock price has never recovered. Stock price, back before the transaction, was $32 an ADR, roughly speaking, in 2006. And today it's, even though it's had a good performance this year, it's at $6.50. And it went all the way down, I think, at one point to like $4, $3.50. So Cemex, it's very unlikely that it'll ever recover the stock price that it had before the Rinka transaction, even though the current CEO has done, I think, a brilliant job in deleveraging the company. It's regained investment grade and sold off a lot of the assets, mostly in emerging markets and not in the US, to make it a more solid company.
But it took them, 12 years? No, less, nearly 16 years. Oh, I don't know, 24 to 8, 16 years to recover.
And then there's some cases where I think there have been some pluses and minuses. You can't really call it a huge victory nor a terrible mistake. Televisa, they merged their content division, their TV content division, as you know, with Univision. At the time, that looked like a great deal for Grupo Televisa. They ended up with 45% of Televisa Univision, so they were the largest shareholder and effectively controlled the company. And they also got a bunch of cash, $3 billion of cash from the transaction in return for folding their content business into the new company, which helped them deleverage at the Grupo Televisa level. The problem with the transaction, really, I would say twofold. One, in order to pay Televisa Univision was saddled with way too much debt. So it had a debt to EBITDA ratio around about 7 times. And at the same time, the growth of the streaming companies, especially Netflix, obviously, and also the growth of digital advertising on Google, on YouTube, on Facebook, TikTok, and so on, has sort of squeezed advertising in Televisa in the US and in Mexico. So it saddled all this debt. Their business become a lot less profitable than it was as a result of that. So the 45% of that business is now worth very little. Some people even think that it's not even worth the debt that's at Televisa Univision. So then Televisa is left with its other businesses, which is cable TV and internet, Izzy, which also hasn't done especially well, which is now being merged into Sky, which Televisa controlled. And so Televisa's stock price has fallen also all the way to $2 or less than $2 a share from at one point it was over $40. So I don't think that deal in the end was success, although you could argue it wasn't a failure because they went into the US, but it was a failure because of the technological changes that undermined the business model. American Mobile, it's a big success, although they're no longer in the US. They bought TracFone, I don't know if you remember them.
Yes.
For very little money.
Targeting Mexicans mainly, no? If I recall correctly.
Targeting Mexicans mainly. And then they were able to sell it to Verizon for over $6 billion. So that was a huge return on investment. And I think the lesson there was at the time, Telcel, American Mobile's Mexico division, had a kind of unique expertise in managing prepaid. In fact, I think by some measures, they were the first prepaid mobile company at scale in the world. Because most Mexicans obviously don't have credit cards, and that was the only way to go. And most Mexicans living on very low income, especially back then when mobile costs were much higher, they were only going to put in as much money to the phone as they could afford. And they were able to parlay that expertise into, creating a very successful firm. And I think Slim was very smart in getting out when he did, because in the end, the entry barriers to the virtual operators are quite low. And we've seen since then a proliferation of new brands. If you go into any supermarket in the US, you'll see 20 or 30 of them, and margins have come down.
So he got in at the right time and left at the right time. And his investment wasn't that large, if I recall, because of this technology that he took advantage and he knew from American Mobile.
Yeah, so I think he bought TracFone. Obviously, they put some money in afterwards for $60-70 million.
Right.
So it was a tremendous return.
Huge.
And I think one of the lessons from this is, if you can use the kind of unique expertise that you have in Mexico, and if that's applicable to the US, you can do quite well. Grupo Bimbo has also, over the last 20 years, been on a shopping spree in the US, and it's been successful in the sense that they're now the largest baker in the US, and it's helped diversify them away from Mexico, where they're completely dominant and really no room for growth. But the returns of capital in the US, if you look at what they've spent to what the cash flow that's been generated, is still way below what they get in Mexico. And it's a much more complicated business. It's got a very high distribution costs. In the west of the United States in particular, it's highly unionized. And of course, they don't have the same pricing power in the US than they have in Mexico, despite building up their share. I think they'll be happy, and I think their investors are happy with how it's turned out. But it certainly hasn't been able to replicate what they had here. Another success story is Arca Continental, which bought in the south of the US a couple of bottling companies, and Arca's stock price, despite the woes in Mexico, has doubled over the last 3 or 4 years, and partly because the results in the US have been really quite good. And they were able to bring down costs, improve margins, and show that skillful Mexican operators can do a great job. And Chedraui, which now gets about the Mexican supermarket retailer, historically in the southeast of Mexico, as you know, has expanded aggressively in Southern California. And there were skeptics in the stock market at the time, but it's turned out to be a pretty good investment. It's now about 50% of the sales of the whole company. And the margins, while they're not as good as Mexico, have been satisfactory. And also Chedraui's stock prices, for example, way outperformed, Soriano's or even Walmart Mexico's listed division here in Mexico. And in part, that's because they've been able to kind of exceed expectations in their Southern California business. So I think it's a mixed story.
Mixed bag.
I think the right hurdle is not so much to see if you can get the same returns as in Mexico, as that's very unlikely if you have a dominant position here. It's whether the returns on capital are higher than your cost of capital. And in some cases that's happened. In others, it hasn't. I think that A very interesting case looking forward will be FEMSA, which has just announced it through OXO, through its mom and pop retail chain, a small acquisition in the US.
Correct.
And I think the market likes FEMSA's approach, which is to go small, build up organically,
Be
and
careful, in other
and,
words.
and not make a giant acquisition at least until you know the market really well. So start with something small, get to know the business, have people in the US. And that's kind of what ARC has done. That's kind of what Chedraui has done. And Bimbo to a less extent because they spent a couple of $1 billion on one of their acquisitions, but over time, it's also what Bimbo's done. Whereas I think Cemex and Vitro went for these kind of from
Big.
very little to a huge player,
Correct.
and that's much riskier, and especially if you're going to take on a lot of debt, and especially if you're going to take on a lot of debt just before the market turns, as happened to Cemex and even to Vitro because they did it just before oil prices spiked.
That's very interesting, Damien. Shall we move on to listen to our experts and see what they tell us about Mexicans investing in the US?
Sounds good. It's a real pleasure to have with us today Gerry Schwebe. Gerry is the executive vice president in the corporate international division of IBC Bank in Texas and Oklahoma. It's a state chartered bank with branches in over 75 communities in Texas and Oklahoma. Its total assets are over $16 billion and is one of the top three performing banks in the country. Gerry has, I think, 40 years of experience of helping Mexican companies grow in the United States. And today we're going to ask Gerry a little bit about how he's seen investment from Mexican companies and Mexican family offices in the United States, how that's developed over the years. What lessons has he learned from what strategies work and what strategies don't work as well. So with that, I'm going to hand over to Gerry. Thank you very much again for being with us and tell us a little bit about what you're seeing right now with Mexicans investing in the United States.
Well, thank you for having me, Damien. So traditionally, our Mexican investors would seek to invest in the U.S. for security reasons, for currency fluctuation reasons. Over the course of the years, they would grow and bring those funds. Many of it would be their patrimony or whatever profits they would make from their companies or personal assets, and invest them in the U.S. Then travel, maybe buy a second home, eventually shop. Eventually, their children would come be educated here, and eventually, consider doing business in some form or fashion that would allow them to diversify a little bit more their risk in Mexico. So that's been the more common type of investment. But over the course of I would say, last 20 years of my career, and as you said, I've been doing this for over four decades. It's been more solid investments, and more on the entrepreneurial side, more seeking to leverage any, well, you might want, let's call it political risk or credit risk they may have in Mexico, and invest in other projects here in the United States, whether it's real estate investments or franchises, small businesses, or even in the area of innovation and technology. That's what I've seen.
And what strategies have worked for the most part, and where have you seen things not being successful?
Well, let's start with the successful ones, and I always like to focus on the positive side. That's that if you come to the United States and you seek guidance from those that have been here already before or are investing, whether they be family or business friends, it's always wise to ask, how did it go, what's going on. It's also important that I make three recommendations. Number one, I recommend that they seek legal advice as to what is the best structure for them to establish any form of business in the United States. Number two, an accountant to really help them in all their fiscal matters and tax return matters they may have in the United States, and preferably someone in the accounting field that has also experience in understanding the Mexican culture. And finally, and this is where I come in, seek the advice of a bank that has also experience in dealing with clients from Mexico as they seek wanting to do business here in the United States. A bank like IBC is one that we help them, guide them, and maneuver through their plans in the United States.
Gerry, one question is it whether these entrepreneurs, these Mexican entrepreneurs, do they invest more seeking the Mexican communities that they know from Mexico that are now in place in the US, or are they trying to reach U.S. customers?
It really, you would think that they would seek more of the Mexican client base, but quite frankly, it's so diversified in here in the United States. They're basically looking for U.S. business, and I will tell you, there's three sectors predominantly. Maybe will be different to what I just said, where you would tend to go with a Mexican market in the United States or a Latino market, as they like to call it here, and that would be in the area of agriculture with fruit products. Did you have a rise in the population of Hispanic population? I don't care what it is, Mexican, Central or South American. So the area of agriculture and food products is a rapidly growing one. But then you have the area of, quite frankly, as I said, the technology and the innovative areas, especially California, Texas, Austin, the Silicon Valley. There's a lot of dynamic engineers in Mexico. They've got the best great idea, and therefore the biggest market will be to look at how do you deliver that idea, execute it, and turn it into a needed product in the U.S. market.
Do you see Mexican businessmen, when they invest in the US, sort of integrating with existing Mexican businesses, taking advantage of lower costs in Mexico and setting up a beachhead in the US, which they then grow? Or do you see more kind of standalone, separate US businesses that aren't related very much to what they already have in Mexico?
I think we have both, Damon. I think what you have is that if you have family that has been educated in the U.S., let's say a son or a daughter or family member, and they, for all lack of a better word, have become enculturated to the U.S. business model, it's easier for them to just venture into the U.S. business model of U.S. companies. When you have limitations, you may have a problem with the language and you need to want to seek others. You tend to go with those that speak Spanish and maybe are more involved and align with your thinking. So you have a little bit of both. You have those that have family members that have already been here, been enculturated, and know the business model because they've been educated or have been working here in the U.S. And then you have those that have no ties to anyone in the United States. They'll tend to go with a Mexican organization like the Mexican Entrepreneurs Association or an Hispanic Chamber of Commerce, where they'll find similar folks that speak the language and can offer them some guidance as well.
What about geographically, Gerry? Do you see more of the Mexican entrepreneurs going to the east or the west coast rather than in the middle America, or is it all over the U.S. territory?
I think it's all over. I think it's quite frankly, I've seen it because I'm predominantly in Texas. I see a lot of it in the major metropolitan areas of Dallas, Houston's, Austin, San Antonio areas is where I see a lot of the technology. Austin is a high-tech area that we've seen a migration of California, Silicon Valley companies looking at Texas as another option because it is perhaps more pro-business and maybe fiscally more attractive to entrepreneurs and businesses. But I quite frankly, cities, I also see many of our clients doing business in the Midwest, into Chicago's, and they go to Atlanta's and Kansas City's. That's where I think their opportunities also lie. You follow the potential market that's available to you. That's what you're seeking. Sometimes if it's saturated, you'll try to go for somewhere where it's not. So there's no limit to where in the United States one can go. And they do it right, and they have, a product a consumer will want.
And culturally speaking, the Mexicans need to learn something that they have to do differently in the US than they do back home. How does that work, or how do you explain that to them?
Well, it's one of the things I ask my customers is to be patient, okay, and to listen more than speak, because sometimes it's, as a saying in Spanish, al zapatero sus zapatos, right? If you're used to doing this business in Mexico, let's say you did manufacture shoes, and you want to come over here and you want to open a restaurant. Well, if you never owned a restaurant, restaurants are very, is a tough business in the United States. Everybody's got one. You need to be patient and understand the market. And a lot of times, folks will not analyze the market. They have an idea, they have a product. My grandmother gave me this recipe, for this food product, and I know it's a hit, and it may not be a hit depending on where you did it. Right now I see it a lot in the beverage area. I've got the next great mezcal, or I got the next great tequila. It's how you market it and how you penetrate that market and how you offered it. But so it all depends on the product and how do you match it. So I do ask them to be patient, to analyze, study the market before you launch and roll out and invest all your capital in it.
What do you think is going to happen under President Trump? On the one hand, Trump wants the United States to draw in more investment, and one of the ways he's trying to achieve that is putting tariffs or threatening tariffs. We saw this week 25% on steel, and that may work. People may decide to invest in the U.S. as the only effective way to get tariff-free access to the U.S. market. On the other hand, Trump might put off Mexicans and say, "I don't want to invest in a country run by someone who, in the past at least, has been accused of sort of xenophobia and anti-Mexican behavior." So how do you think it will pan out under this new administration in the United States?
Well, from my perspective, and having been involved in a lot of trade agreements, the North American Free Trade Agreement and on the USMCA, I follow the same line that many of our leaders have said. We're stronger together than we are divided. So with the three countries, we have natural resources. We're always going to be neighbors, so we got to work together. And at the end of the day, governments don't trade; it's the people that trade. So it's the private sector that is going to generate jobs and create the innovation of tomorrow. Yes, we may have governments that may impose certain policies or procedures that disrupt business model, but it's important that we understand that it's the private sector and it's the business community that drives our economies. And if you have a strong economy, politicians get reelected. If you don't, and if the opposite happens, if the economy, the consumer is hurt or the voters are hurt, then they'll go to the booth and say, "No, you're not our candidate." I see that we have in President Trump a different type of president. We had the experience, 4 years of him before, and this is a new 4 years of this administration. And quite frankly, I think what he's trying to do, and what I see him doing, is he's just trying to find a level playing field. Tariffs with tariffs, reciprocity. If you charge me 10%, I charge you 10%. The hard part is that you're going to have all kinds of speculation, and that speculation leads to uncertainty, and uncertainty is not good for business. That's the challenge that we have. So I'd rather have that the rules be established and be given to us, and let's work within those rules and those parameters, and the people will adapt, and the business community will adapt accordingly, and we'll move on. We've been, especially for those of us that do business in border states like Texas, and I've been doing business on the border most professional life. We've been to peso devaluations. We've been to nationalizations of banks in Mexico and privatizations, and we've been all these. The resiliency of the people, the business community, the people is remarkable. We adapt, and that's what's going to happen, I think, in the Trump administration. Yes, there'll be pain and there'll be a disruption, and some people don't like change, but let's stay focused on our business model and see what the impact of these decisions are in our businesses, and adjust to that. That's because we can't stick our head in the sand and say somebody else is going to solve our problem. We're going to solve our own problems.
Hey, well, Gerry, thank you very much for spending some time with us, giving your insights in the Mexican community investment model in the U.S. Appreciate you. Thank you very much.
Well, thank you for having me.
It's a real pleasure to have with us today Alvaro Rodriguez. Alvaro is the founder, CEO of Ignia Partners, one of Mexico's top VC firms. He's previously been the CFO of leading Mexican companies like Vitro and Electra. He's an executive fellow at Harvard Business School, formerly on the faculty, and he's still teaching there. Thank you very much, Alvaro, for being with us today.
Oh, thank you, Damien. It's a pleasure. Thanks for your invitation.
Alvaro, as you know, today we're looking at Mexican investment in the US and what lessons can be drawn. You've been involved for most of your working career in investing between Mexico and the US. What lessons do you think can be drawn from successful and less successful Mexican forays into the US market?
Well, as of late, there's been quite a few, but we have a lot of history of companies going into the US. And the main lesson is a completely different ballgame. And this is a little bit of a cliche than operating in Mexico. Basically, the rationale from you going to Mexico to the US is trying to reach a much larger market, but much more competitive and with more compressed margins. But also it gives you access to much more capital than if you're just based in Mexico.
And why are margins so much lower in the US than Mexico for the same Mexican company selling the same product? Is it simply a question of competition, or are there other factors at play?
Well, I'm sure there are other factors at play, but yes, there are multiple examples of companies in Mexico that have much larger margins than in the US. For example, Walmart, which we all know, the EBITDA margins of Walmart Mexico are 2 times the EBITDA margins of Walmart USA, while their gross margins are the same. So there, maybe it's just a cost of labor. But there are other cases, like, for example, Bimbo. Their margins in the US are half of the margins in Mexico. And maybe there you could explain it, and again, I could, by competition. The cost of distribution in the US is much higher. So there are different factors why this could be. But the overarching data tells you that margins in Mexico are much higher. Mexico is a very generous market. Now, the other reason is large companies in Mexico are not threatened. You know, if you operate in the US, there's always some startup, some new company that is a newcomer with a new solution, with a new brand, with a new value proposition to the consumer or to companies if they are in B2B. In Mexico, you seldomly have that because the access to capital is so limited that as a large company, you are tremendously protected. There's a very thick glass ceiling in Mexico for companies to rise to be large. So that protection makes Mexico a very generous market for large companies.
So Alvaro, when you tell someone that wants to invest in the US these conditions, do they scare them off? Or how do you pitch it to convince them to go ahead and invest in a much more competitive, less generous market, as you said?
So I'm not in the business of convincing Mexicans moving into the US. Mm-hmm. But my experience, for example, when I was at Vitro, about a fifth of our sales were from our US subsidiary. That gave me a lot of experience of how tough it is to operate in the US. So if anybody's doing it, I might tell them, look, Mexicans tend to complain a lot about the conditions under which they operate in Mexico. And I tell them, don't complain too much, because when you go into the US, you realize what tough operations are really all about.
The Vitro acquisition of Anchor Glass is an interesting one because I think it was, if I remember correctly, the first large acquisition of a US company by a Mexican company. In fact, when it happened, I think a lot of Americans said, what the hell, who is this Mexican company buying one of the biggest brands in the US? And then some years later, Cemex did an equally audacious move, buying Rinca for $16 billion just before the 2008 financial crisis. You were, I think, quite familiar with both of those transactions, and both of them, with the benefit of hindsight, went terribly wrong. And really the stock price of neither company, for these reasons and no doubt for other bigger reasons, never really recovered. What do you think they did wrong? What should they have done differently? Take into account, of course, that we have the benefit of hindsight.
Yeah, I mean, the Vitro transaction acquiring Anchor Glass was before my time, but having been in there, I got to learn quite a bit about it. It was a very important transaction. It made the news because it was the first large transaction of a Mexican company acquiring a large US company after NAFTA was signed. So it was like now Mexicans going aggressively into the US. And it's important not to lose sight that at the time, Vitro was the largest private company in Mexico, the second largest company in the country after Pemex, the government-owned oil company. So Vitro at the time was a huge conglomerate. And what happened then, it was things that were very difficult to have a foresight on. One is there were 5 glass bottling companies in the US, and nobody could have foreseen that there would be 2 mergers of 4 of them. So then Anchor Glass ended up being in the middle of these 2 big glass bottling companies, and they just got squeezed. And at the same time, that's when PET started to rise, which again, it was very difficult to foresee. And it was a mix of oil prices, et cetera, et cetera. So it was a perfect storm for them. And these mergers got squeezed, PET going up, and they just got crushed. So one could say in many ways it was bad luck, not necessarily bad strategy. On the case of Cemex, my view of this, it was the structure of the financing. They financed a lot of their balance sheet with short-term debt. At the time, the yield curve was very steep. So, and they were investment grade. They didn't think they needed to finance long-term. So when the 2008-2009 financial crisis came around, they couldn't refinance, and that really got them in a bind.
So, Alvaro, but I guess the question that begs to be asked is, are there rewards to go to the US after we've talked about two cases that didn't work out? Obviously, Bimbo did, but what's your experience on that front?
Well, the interesting thing is that the top Mexican companies are from old economy, right? And the top US companies are from new economy. So if you look at the US stock market, the new economy companies are taking more and more of the share of the market cap. So one could argue, old economy companies are getting out of vogue. We still need to build things and eat things and buy things. So all the economy companies could do well, right? And there is some truth to that. There are a lot of investors that have made a lot of money in very unsexy businesses, right? And the Mexican companies that have gone into the US going with very unsexy businesses, right? Selling bread, selling cement, selling soft drinks. I mean, these are all very unsexy business. Again, their logic in many ways, I guess, is go and try to go into a much larger market. Maybe it's also diversification of risk. Maybe it's also going into market where you can get much cheaper capital. The old Panamco, who used to be a big Coca-Cola bottler, their headquarters were in the US, so they could get a much cheaper financing, right? So the access to capital is very different when you're based in the US. That could definitely be a reason. So it's diversification, large market, access to capital, access to cheaper capital. Those could be reasons to go from Mexico to the US.
And on the new economy, you're very pegged to that one in the sense that we do see some entrepreneurs, Mexican entrepreneurs, going to Silicon Valley to accelerators to learn how to do technology like Clip or Encode. Those are two Mexican companies that come up to mind that have established in the US to take advantage of the knowledge and I guess also the cheap capital that you mentioned. Am I right in then having some hope that the new economy is also raising interest?
For example, Encode has been smart in setting themselves up in the Bay Area, even though they operate in Mexico. So investors see them as a US company, even though they operate in Mexico, for example. I'm not sure how valuable the lessons are in learning how to operate in Silicon Valley to be brought into Mexico. It's a completely different ballgame. And some people make that mistake, thinking that, I've done it in Silicon Valley, so now I'm going to bring those lessons into Mexico. It's a completely different context, and we don't have the time to go into those differences. But I would put a big word of caution on that. Now, it is not a bad idea to set yourself up in the US and operate in Mexico, because you're going to have much, much higher access to capital by doing that.
Great, Alvaro. That was super interesting. Thank you very much for your time, and I hope you come back on the program at some point in the future.
Thank you. Thank you very much, Eduardo and Damien. Congratulations for your show, and we'll be in touch.
So, Eduardo, you've been doing a little bit of work on the implications of President Trump's announcement this week, put 25% tariffs on steel and aluminium imports, so far at least without any exceptions. So Mexico and Canada are going to have to pay these tariffs in March if they don't get cancelled, as we saw with the previous tariffs on Mexican goods. What's your take? What impact might that have on Mexico and indeed on the US?
Well, we've seen this picture before, Damien. As you know, President Trump in his first term did a little bit of the same. He put a 25% tariff on steel and a 10% tariff on aluminum back then. They were in place for a little while. Eventually, Mexico did place tariffs on products that hurt Trump, and they reached an agreement and took them off. This is a different Trump. So even though Marcelo Ebrard, Mexico's economy ministry, just 2 days ago was very optimistic that he could convince Trump of not going ahead with these tariffs on Mexican steel and Mexican aluminum, I think he will face a tougher battle this time around. His main argument, which is not bad, is that Mexico imports more steel and aluminum from the United States than it sells. He said that Mexico has a deficit of $6.9 billion with the US in those two products. So he's going to tell Trump's lieutenants that it makes no sense, that this could hurt this surplus that the US has with Mexico. I think it's a valid argument, although it could turn around later on to hurt Marcelo because Mexico has a surplus in overall trade. So then Trump could come back and tell him, well, you told me not to do it because in this case you were buying more than we were, but what about the other way around? So I don't know. It's a tricky business on how he will try to convince him. Now, looking into which companies will suffer the most on the stock market in terms of steel products, there aren't any more that are traded there. Ternium is one Mexican company that sells steel products to the US. Altos Hornos, but I don't know what the situation is with Altos Hornos. Apparently, it's in Chapter 11 here in Mexico. I don't know if it's operating even. The Acero is another company that sells steel products. Oh, I've got one. Grupo Cimec does have a large presence of specialty bars and other products in the US. They will be probably the ones that will be hurt the most on the stock market. Grupo Acerero is another one. Villa Acero is another one. Nacional de Aceros is another company. In the case of aluminum, the most affected company will be Nemac, the auto parts subsidiary. Well, it's no longer a subsidiary of Alfa. They do produce many components like engine blocks, cylinder heads, transmission parts that are aluminum based and are sold in the US. So they will be probably impacted heavily if these tariffs go through.
Yeah, I think that's a key point, which is still a bit unclear based on reading the White House fact sheet. To what extent will the downstream products, like blockheads from Numac, be exposed or not to this tariff? Because the first tariffs back in the first Trump administration were only on the raw material, steel and aluminium. So obviously that wouldn't affect a car part company like Numac. Now they're talking about putting the tariff not just on the commodity, but also on downstream finished products. So you would have to then look at, to the extent that this is applied, how much metal and aluminium is in your product, how much of that came from the US, because a lot of it is bought from the US, and that wouldn't pay a tariff, and how much of it came from Mexico or from third countries like China, and then you would have to pay a tariff. So it's going to potentially create quite a logistical complexity if it goes through as the fact sheet indicates. I think what the Trump administration and Peter Navarro, the architect behind this, are trying to get at is that Mexico, in their eyes, has become a backdoor entry for Chinese steel and aluminium. So basically, the Chinese send it to Mexico, add a little bit of value, so it's no longer steel or aluminium, and then send it to the US tariff free. I think Mexico's going to, and it's already doing this as I understand, is going to have to cut down on that to the extent that it's happening, and we could see much tighter rules of origin in a future sort of USMCA Part 2. And in the meantime, if they really go ahead and try to tax the downstream products that use steel and aluminium, that could have quite serious implications for the broader Mexican economy, not just the steel businesses, because it would obviously hurt car and car part exports that use a lot of steel and aluminium. So I think Mexico's negotiation with the US in the short term between now and March will be very much on trying to narrow the tariff as much as possible to simply the steel and aluminium and not the very downstream products, or at least make a cutoff point that gets before cars and car parts. And the US will be pushing against that, because otherwise this is effectively a tax on Mexico's biggest export. As I understand it, the final details haven't been published yet, so there's still still room for changes. And of course, Mexico could be exempt altogether, although as you say, that doesn't seem that likely. Last time round, Mexico, when faced with these tariffs back in the first Trump administration, cleverly didn't retaliate by putting tariffs on U.S. Exports to Mexico of steel and aluminium, which would have shot Mexico in the foot, as it needs that steel and aluminium from the U.S. to make cars and car parts, but put it on other products,
Exactly.
like bourbon whiskey in politically sensitive areas, oranges from Florida and so on. And that, along with other things, no doubt, helped sort of do the trick, and those tariffs got lifted.
And the other thing that Mexico could also negotiate is what you just said about making sure that aluminum that comes from China, Russia, wherever, that is smelted here, that will not be allowed. In other words, that the aluminum that is not from the US or Canada, that is used to add value to an auto part, needs to be from the region to avoid the tax. I wonder if that could satisfy Pete Navarro and company. We'll have to wait and see.
That's right. Well, thank you, everyone, for joining Mex Moves, and hope to join you next week.
Thank you, everyone, for listening. We'll talk next week.